Today I'm going to talk about one of my biggest positions, Bellway, which is a UK-based home builder, and I think it's really a great risk reward at the current price. Um, so here is just the agenda of what I'm going to be talking about. I'm going to go through quite a bit of description about the industry and the company's track record before we wrap it up with the valuation. Um, Before I get into the specifics, let me talk a little bit about what I usually look for at Olufsen Value Fund. And I think Bellway fits this pretty well. So I would say that in principle, I'm um, I, I'm a value investor first of all, and in principle, I'm agnostic as to what type of situation I look at. I definitely would tend to have some bias towards more predictable businesses, and that I think also typically comes with a little bit higher quality businesses, as well as businesses with very strong balance sheets. Um, uh, I would also say that I normally look for businesses that are easy to understand and where you can value the business with some reasonable degree of accuracy. So I don't usually look at businesses with immature or young business models. I usually focus on businesses that are pretty stable and, like I mentioned, with strong balance sheets in order to avoid the possibility of a permanent loss of capital. Um, as you'll see in this presentation, I also tend to focus on companies that have a really long, good, and pretty consistent track record. And we'll get into Bellway's track record in some detail. Um, I think I usually try to invest, based on a lot of good evidence, and less so based on a story or speculation or a narrative or anything like that. So ideally a track record that goes back many years, um, and that includes some situations where the business was stressed, such as a recession, severe financial crisis, or anything like that. Um, I usually look for compounders. Bellway definitely fits this criterion, as we'll see on some of the slides as well. In general, I think it's a lot easier to estimate value than it is to estimate when the market will, um, you know, um, become more interested and push up the price of a security. Um, so if you have a compounder that grows or compounds its value, especially on a per share basis over the long run, the value of what you own is growing. And so if it takes longer than expected for the market to recognize the value in the investment, you benefit from that compounding of value while you hold it. I usually look for very shareholder-friendly companies. If you don't want someone to, take the value that you've identified, you only really benefit if the value actually accrues to you, the shareholder. I always look for something that is pretty quantitatively compelling, from a valuation standpoint. And finally, it's what I call a sleep well at night investment, um, just something where you don't have to worry that, say, the business is not going to be the same in a couple of years, or that management or the board or another controlling shareholder is going to do something to your detriment, or that a recession is going to put the company out of business or force them to raise capital on extremely dilutive terms because their balance sheet is too leveraged, for example. So in other words, boring investments are good. Now let's talk a little bit about Bellway. So Bellway is just a pure home builder. It was founded shortly after World War II in the northeastern part of England. It's been public for a few decades. It was founded by, I think, John Bell, and his family was also involved in the business, at least up until the late 90s. But I don't think they have any significant involvement at this point. The business gradually grew from just the northern part of England to today being pretty much national exposure, although today, or for the last few years, Bellway has had very little exposure to London. It's the fifth largest home builder in the UK by revenues today. They simply build single family homes in various sizes, 2, 3, 4, even 5 bedrooms, with slightly below average price point typically, and a market cap of £3 billion. So I'd like to talk a little bit about the home building business as well. This is a business where demand is highly sensitive to sentiment and economic conditions, and where the supply of homes adjusts much more slowly than demand does. So you have volatile demand and pretty pretty fixed supply, at least in the short and medium term. And that's a prescription for a pretty cyclical business, and we'll really see this in the historical data as well in a few slides from now. The business obviously has some fixed costs, the land investment being a significant part of that. And so when volumes go down in a slowdown, the margins are hit. And that being said, Bellway has actually almost always been profitable. They had a small loss in the financial crisis, but although they generated positive cash flow, they had a small land write-down in the financial crisis, but generated positive free cash flow, and the free cash flow in a downturn is actually further boosted by the fact that the quote-unquote inventory, which is land and work in progress, is freed up when the volumes go down, as they do in a downturn. So that also, provides some, supports from a, financial condition standpoint or from a balance sheet standpoint in a downturn. Now, even though demand is quite volatile and cyclical, I think that in the long run, demand is probably pretty price inelastic. And I say that because housing is a basic need that everybody needs, and it doesn't really have any substitutes. There's no technology that can, replace housing, obviously. I think the long-term demand for the business uh, being a home builder focused exclusively on the UK, are pretty solid. Like I mentioned, there are no substitutes for the product. The product, I think, will always be in demand as long as there are people. And over the long run, I think population growth and also growth in GDP per capita will underpin the demand. I think you can look at home building as essentially a manufacturing business. Uh, you know, they manufacture houses, and the raw materials are land and the materials and labor that go into making the houses. However, it's a business. It's a manufacturing business where you have very significant inventory holding gains or losses. Um, because the value of the inventory, residential real estate fluctuates, and you hold, especially the land, on your balance sheet for a long time, for years actually. Um, so that's really how I view the business, and because of the issue around the quote unquote inventory holding gains and losses, we'll look at residential home prices in the UK as well to assess just what the risks are in the land bank and the work in process that they have, to the extent that it's not pre-sold. So here we have the median house price to median income uh, in England and Wales. That's the red line, and above that we have that for just London in the black line. And this chart goes back to 2002. As you can see, um, the house prices relative to income in the UK have not experienced the big increase that we've seen in the United States and also some other parts of the world over this long time period. Home prices are up slightly over this period. Um, and that's not quite true for London, as you can see. London was very strong from around the post the financial crisis up until around Brexit, um, and it's essentially, still very expensive. If you stripped London out of the total for England and Wales, the red line would actually be a little bit lower, especially towards the right side. And that's relevant because Bellway has less than 5% exposure to London today. And so I think that's important because they don't hold significant land that is exposed to a potential large decline in home prices. On this chart, we have just a different measure of the how expensive home prices are in the UK. This really takes the level of interest rates into account, because obviously most people finance their home with a mortgage. And this shows the mortgage payment as a percentage of income for someone who's making a new purchase of a home. And again, you see London is more expensive, and London's the blue line. UK, again, including London, is the red line below it. Um, it shows essentially the same pattern as the previous slide. So basically, having almost no exposure to London, I think Bellway is in a good position. I think the risk of a substantial drop in home prices in the markets where they operate is pretty low. There's no particular reason, I think, because home prices outside of London don't really appear to be significantly overvalued, to me anyways. Maybe they're slightly overvalued, but I don't think significantly. The UK home building business, there are a few aspects of it that are important to consider. First of all, the so-called planning system, which is the system that you have to go through as a home builder to get permission to build a housing development. The way the system operates really impacts the business in a few different ways, and I think it's important to understand it. The system is extremely slow, very bureaucratic. It requires real expertise. It's expensive. The outcome is uncertain, and maybe especially the timing of when you'll get planning permission is pretty uncertain. And this makes it very difficult for small home builders to operate. To operate efficiently as a home builder, you need to have a pipeline of sites on which you can build and keep your crews busy pretty continuously. And because of the uncertainty, especially around the timing of when you will get planning permission for development, you need to have many different sites in your pipeline. And for a small home builder, that's just really difficult to do. It's also difficult for them, more difficult for them to really navigate the complexities of the planning system. And this has become, the planning system has become more difficult over time, and that has definitely contributed to a very significant decline in the number of smaller home builders in the UK, which actually goes back to even the late 80s, early 90s, and certainly also in recent years. The planning system also means that the supply of new build homes is somewhat constrained because you can't easily get planning permission, and you can't get it quickly. So it probably causes supply to adjust even more slowly to demand. And that makes the business maybe a little bit more cyclical, a little bit more volatile, because the supply is a little bit more fixed. I will also say that the UK being somewhat land constrained and especially the planning system causing constraints on supply, it means that most land that has planning permission, even if it's just outline planning permission as opposed to detailed planning permission, but if you have outline planning permission, you will probably be able to get detailed planning permission. But land that even has outline planning permission, probably most of it has some inherent long-term value. I think it's just a matter of time before it makes sense to develop something on that land. There has been some consolidation in the industry. I think maybe especially the small home builders have been going out of business for years. But we've also seen a little bit in the industry, both around the time of the financial crisis as well as in more recent years. That there do appear to be some benefits to scale. The land market is quite different in the UK than it was before the financial crisis. And here I'm just going to jump to the next slide and show you residential development land prices in the UK. There's an index that's published by the broker Savills in the UK that goes back to 2007. And I think it's an imperfect index. These plots are all unique, but um, big picture, land prices dropped drastically in the financial crisis, and they recovered uh, almost to their 2007 peak in nominal terms, but in real terms, they're still quite muted there. And um, What's different about the business today and the land market specifically is that um, there are a lot fewer bidders on residential development land today than there was in the mid 2000s when the housing market was hot and many people wanted to be developers. And I imagine that many developers were projecting continued strong house price increases in their models when they were calculating how much it made sense to pay for the land. Today, that's not the case anymore. The housing market is completely different. It's not nearly as hot as it was in those days. Um, the consolidation has probably also helped a little bit, and I would say that the the home builders after the financial crisis became more conservatively run, and I think that probably also means that they are more conservative in how they bid on land. Um, and I think today the um, all those larger home builders, they use very similar models to evaluate land, and they also, I think, use similar hurdle rates. So for that reason, I think uh, they typically don't get into, you know, really bad bidding wars for land. So it's a much more rational, disciplined industry than it used to be. Um, so the UK home building business is quite different from, say, what we've seen in the US home building business. With the big interest increase in interest rates since around 2022, the demand for new build housing has really dropped significantly in the UK. And that's really the whole source of this investment opportunity. And I'll get back to that all more. It's really uh, a cyclical a decline that the industry has faced. Um, the cost of living was also fairly significant in the UK, and that has also impacted um, demand for new build housing. Um, Here, I'll this is a pretty messy chart. This shows 7 of the 9 publicly traded home builders in the UK, their ROE going back about 25 years. Um, there are 2, I guess, that are in existence today, but that don't have the full history and are not included. Um, and One thing I think I'll point out on this chart is that Bellway's performance, which is the thicker red line, was better than most of its peers in the financial crisis. And I think that really comes down to being just more conservatively managed and probably better managed. The other 2 that did relatively well were Berkeley Group Holdings and Persimmon. And I think Berkeley, Persimmon, and Bellway are probably the 3 best home builders, the 3 highest quality home builders in the UK. Um, we'll get to the valuations a little bit later. Um, Looking at Bellway's historical performance, this is book value per share. The blue bars is the book value per share of Bellway going back as far as I could go, about 30 years. It's compounded at 15.2% Um, if you look at more recent years, it's a little bit less than that. You could look at the period from the peak in '07 to, say, the next peak in 2019, and the CAGR, essentially the geometric average growth in the book value per share. By the way, I'm adding dividends, so it's growth in book value per share plus dividends. But that was a little bit lower, close to 13% over the '07 to '19 period. And I'll point out that the slump we had after '07 was probably a bigger than average slump for the housing market, and the '07 peak was probably a bigger peak than the 2019 peak was. So you could probably argue that the 12.8% is a little bit low in terms of an estimate of what the mid-cycle ROE or mid-cycle compounding of book value plus dividends could be expected to be over the cycle. Looking at the historical valuation, also going back about as far as I could, um, today or yesterday, it was at 87% of book value, which is the same as tangible book value in Bellway's case. Um, Going back historically, over this time period, the multiple has been about 45% higher than where it is today on average.